Welcome, everyone, to this episode of the Expansive CEO podcast. I am your host, Hannah Chapman. It is currently Thursday, June 26th, 12:09 Arizona time now that I'm in Arizona, which is 3:09 Eastern time, just to give it a little bit of a range there. So that's the timestamp we're going to put on it. And it is Investment Friday. Brad Haines, the Chief Investment Officer at Juncture Wealth Strategies, is here with me again. And we're going to talk about the weird cycle that we're in right now, because right now the markets are being a little contrary or contrarian, you might say, in some ways. So, Brad, let's dive into it. What's going on?
Yeah, so it's an interesting, and I've had a lot of clients ask me about this and advisors, and they're like, look, for example, this morning we had first quarter GDP come out at a negative 0.5% revision rate for the first quarter.
Right.
And it was announced preliminarily at negative 0.1. So a contraction, not good. Any contraction is not great. There were some reasons for the first quarter preliminary, um, but it came out that wow, they actually had to revise it more negative to negative zero point 0.5. So why is that? Um, so so not why is that, but people look at that and they say it's contractionary, and yet the equity market rallies today pretty nicely, pretty decently.
Right.
Wow, that makes no sense, right? We're in a contracting GDP environment, and yet now equity markets are going up. That makes no sense to me, right?
Well, and going
Well,
up and hitting highs,
yeah, and
almost
it's
like intraday. It's
yeah,
not done
we're at
yet.
our all-time highs basically in the S&P 500. Now, there are lots of areas or more granular segments of the equity market that are not even close to their highs. Emerging markets, small cap, value type stocks are not even close to their highs. But for the most part, the S&P 500 as a widely followed index is saying, yeah, we're at our all-time highs. Um, and I'll tell you that as we're in this we're in this regime right now when it comes to equity market investing, that bad news is good news.
Mm-hmm.
Okay, so if we have negative economic uh, data points coming out, for example, uh, student loan defaults are up pretty significantly. There is starting to show some stress across some of the lending from consumers. Um, all of these negative data points are starting to add up to be good news because investors are saying, well, if there's a lot of bad news, the Fed will have to lower interest rates. And if they lower interest rates, typically then earnings for corporations go up.
Mm.
So they're making that leap of faith or that logical leap to where they're like, okay, bad news, lower interest rates, higher earnings, therefore higher equity prices.
Right.
So it's a train of thought that has come through, and we're seeing it, in the past couple of months for sure. Ever since April 2nd, when Liberation Day, when the tariffs were announced, and we went down to essentially 19%, and then rebounded very, very quickly. Again, that is indicating that investors are like, okay, this is going to be a non-event. The other thing that's really happening, and why are tariffs now being viewed as kind of a non-event for corporate earnings? That makes, again, very little sense to most people.
Right.
And then that's because, and we've been talking about this a couple times over the past year, is that certain parts of the economy are deflating faster than the impact of tariffs will be felt. And a great one is rents. So shelter inflation, which we've talked about, a cooling housing market has been going down the pike. New rents have been decelerating, if not actually deflating, in
Right.
certain parts of the country at a pretty for quite a while now. In fact, I looked up the new tenant index, and I'm going to show you a chart. So for those of our listeners, I'll walk you through it.
Yeah, because the shelter inflation we've seen before when we've looked at the inflation charts, shelter inflation was a big component of the inflation numbers, right? Like it was almost a disproportionate piece that was keeping inflation high for quite a while.
Exactly. It's one of the largest pieces or components of the inflation indices is the shelter inflation. And rent or imputed rent are that's essentially the same thing. They get in there. Now, don't worry about the numbers so much, but I want you to see the trend here. Okay. So this increase, that is really 2020 into 2022 was that kept that was in the CPI data and any of the inflation indexes because of their averaging techniques for a long time. It takes about 9 to 12 months for it to just start showing up. Okay.
And for the listeners, it's showing a high in 2022 of 222.2%. Is that
That's a cumulative number.
a
Yeah.
Q? Okay. So I'm like, that's a lot. Like,
Yeah, and it's actually from the beginning of the time period, which is 10 years ago. But if you go from, 2020, effectively you're up almost 2 to 3 times again that number for rents, meaning your average rent increased by that point almost 2 to 3 times. And that's a rough number.
yeah.
Which what does that do? When rents are going up, then all of a sudden all these homes that are owned can be theoretically rented out if their owner moves out and rents the house, right? And so those higher rents drive the value of personal residences up. So it's something that it's a funny calculation. It may not actually reflect the market today, but it reflects an averaging technique over a number of years. Okay.
Well, and I,
Well,
I do think that people were experiencing that, where
mhm,
you could get a two-bedroom apartment for 750 or $800 a month a few years ago, that thinking of that being, oh, that's gone up to $1,600 or
yeah,
$2,000 a month. That has happened in quite a few markets, maybe not everywhere, but there are a lot of markets where average rents have actually gone up that much in that short of a time period. Um,
absolutely.
so yeah, I mean
Absolutely.
that's the example of that. Or $1,000 has gone up to 2,000 to 2,500 to 3,000.
Exactly. In fact, I've got two married children. Children, they're obviously well grown up adults who
Okay,
who
good.
are
Thank you.
functioning very, very well. But they've both been in the rental market over the past 3 years, and the rents have accelerated pretty dramatically. So again, it's something that unfortunately for a lot of people have it's made the housing prices very, very expensive. Now, this peak was in 2023, okay, or 2022, 2023. That was the peak growth rate in rents. And ever since then, has decelerated substantially. In fact, ever since early 2023 or mid 2023, it's actually been deflating.
Hmm.
Okay. So it's something that um, it's been deflating for quite some time. The average rate of growth is 3.74%. And right now we're at negative 2.2. Again, a long way to go from these rents that have continued to decline. However, it remains to be seen all of that deflation, all that deceleration in inflation in shelter is still yet to come in the inflation rate. And again, it's the largest component of that calculation. So what's going to happen is inflation's going to fall presumably to the target rate for the Fed, if not a little lower, even when we do get the 1 year bump in tariff rates. So again, people are starting to put together that maybe we don't fall into a deep recession. Maybe we just kind of have decelerated a little bit, but we're going to resume consumer spending. We're going to resume uh, decent economic growth, maybe not to our potential, but for sure on the right track of accelerating as the Fed starts to lower interest rates here over the next couple of months. In fact, the second thing I'm going to show you, and this is the chart I'm showing you is it gives you what the expectation in interest rate cuts is between now and December of 2026. So effectively 18 months. Okay. So the next 18 months, how many interest rate cuts are we going to get? Um, and what this is saying right now is uh, the bar chart is this lighter blue, this lightest blue, which is barely viewable, is a month ago's that's the expectation that this is going to be the terminal rate or the rate at December 26, 2026, um, as of a month ago. Okay. The little bit darker shade right next to that was 1 week ago. The little bit darker blue to the left of that one is 1 day ago. And then the darkest blue is as of today. And you can see the trend is uh, the darkest, if you just want to focus your eyes on the darkest blue column, it has grown pretty substantially for lower interest rates over the next 18 months. Now, the reason is all of what I just said was inflation is decelerating, particularly with that shelter inflation component, is going to decelerate faster than people had been expecting. Therefore, we should be cutting interest rates here really soon. In fact,
Mm.
the probability of an interest rate cut in July, which again, it was starting to be in September, but in July, i.e., next month, it has grown to 10% from zero. So
Yeah, interesting.
it's an interesting component. What kind of things is it doing in the financial markets? Well, small caps are rallying much more than large caps. Okay.
And that's because, again, small caps are super interest rate sensitive
Yes.
for funding.
Small caps generally have more debt, more bank debt on their balance sheet than the large corporations who have a lot of different financing sources. They can go to the capital markets, they can go to the banks, they can do a lot of different financing schemes. Whereas small caps, for the most part, it's one or two things. You either go to the equity market and raise money via the equity market, which is very, very expensive, or you go to bank debt financing, which then allows you to bank loans, generally speaking, for at least the small caps, are floating rate in nature, meaning interest rates go up really soon thereafter. Your interest rate on your loan goes up. Uh, that's
So,
the
right.
downside of it.
That would
The
be similar
upside,
to like a HELOC for like a home
yes,
equity line of credit for a consumer that is like, oh, no, it's based on, a certain rate and then it floats, right? So that would be
exactly,
exactly what
exactly.
you're
So
saying.
if interest rates go down, those interest payments float down fairly quickly for a lot of the small caps. So again, earnings go up more than otherwise would be in those areas. So you've seen that. You've seen small caps over the past couple of days really start to participate in the rally. So that's been nice to see.
How do mid caps, so small caps are what's the cap again for a small company in the equity markets?
Yeah, that's a great question. And it's changed a lot. And it depends on who you're looking at, what data you're looking at. So, for example, I believe Morningstar has a certain percentile. So it's not a market value, it's a percentile. And so the top ones are the large cap, the medium ones are so I can't remember exactly the percentiles they use, but it's a percentile based. Historically, it's been 0 to 5 billion was small, 5 to 10, maybe 15. Well, 5 to 10 was mid, and then anything over 10 was large cap. But we've gotten more granular now. There's micro cap, there's small cap, there's mid cap, there's large cap, and now there's giant or mega cap.
Right.
Um, so it depends on who you're looking at, what data you're looking at, and who's providing that data as to that definition. I wish I could give you something more, but it depends. For me, I'm looking at really 10 to 20, 25 billion being mid cap, anything over 20 to 25 billion being large cap, anything over 500 billion being mega cap, anything between really 0 and 10 billion being micro slash small cap.
That was kind of my assumption too. And so that's why I was like, hold on, wait a second. Let me just ask.
Yeah,
Because there's more, as with most things, right? There's more nuance to it than here are your bands. But the reason I was asking, and I have a couple other questions to come back to as well. But the reason I was asking was, you know, a lot of people, when they go into their allocation, if they look at their portfolio, they're going to have small cap and they're also going to have mid cap and then they're going to have large cap, right? So we talk quite a bit on this podcast about small cap. I know you have kind of a bias towards small cap. You really like them. They show a lot of promise PE wise or price to earnings ratio wise. And then we talk about large caps and mega caps, but we don't talk about the mid caps a whole lot. So I was curious what or how sensitive mid cap companies are to these interest rates, and if there's like a an economic environment where they tend to do really well, since we usually have at least 10 to 15% in a portfolio earmarked towards mid cap.
yeah. They act as you would expect, right in between. They're far more sensitive to interest rates than large cap, but they're not nearly as sensitive as small cap because they have some more flexibility in how they're going to finance by locking in rates. They can lock in corporate loans, corporate uh, financing arrangements, which have fixed rate features, so they're not floating as much, but still have a really good opportunity. Usually, they're generating some pretty decent revenue growth. Depending on the area they're competing in. But generally, they're again, as they have little less flexibility than the large cap, they tend to go right in between. So, for example, if large caps up 1%, small caps up 1.5, they're about 1.2, 1.3. It's unusual, but that's the way it is. They're usually not as volatile as the small cap. So sometimes what we'll do is take a look at a client's portfolio, and if they're not really that, they're pretty conservative, we'll do some switches out there.
Interesting. Okay. I thought that was worth talking about. The other question that was coming up, or maybe place to like dive in a little bit more, is with that shelter inflation. I thought we could talk again about how that correlates or kind of plays with the housing market for single family homeowners, because really interesting things have kind of been going on in the real estate market. So again, I just moved from Ohio, from Cincinnati, Ohio, to Phoenix, Arizona, and both of these markets have had really interesting things going on. Our house in Cincinnati was in a good place, good school district, beautiful lot, all of those things. It sold within 24 hours.
Yep.
As soon as we put it on the market, it was, I mean, literally within 18 hours, we had three over asking offers. But in our exact same neighborhood, other homes have been sitting for 2 months, 6 months, 8 months, um, that are like, for all intents and purposes, like similar, but not move in ready as our house was, and as move in ready as we made it for the next owners. Similar thing has been happening in Phoenix, where I was watching this market for a year. looking at houses, looking at what was going on, since last summer, just trying to get a pulse on what the market was doing. Uh, Houses are much more expensive in Phoenix than they are in Cincinnati, Ohio. So we knew we were going to have to pay more. But what has been really interesting is that in Phoenix, the homes just keep sitting. The time on market just keeps increasing. And it has for almost a whole year, where the pricing of these homes and the way that they've increased over the last several years doesn't seem to be holding up with buyers anymore. Where most buyers are like, no, that's too much money for that house and we're not paying it. And those homes are just sitting and sitting and sitting. So I'm curious. We've talked several times about, like there's not enough housing inventory. Overall, most real estate professionals don't forecast a huge crash, certainly not a 2008 style crash in the housing market. Um, but there are these interesting, really, really slow markets right now as well. So are interest rates going to have a big enough impact? Or is it going to have to be a combination of like prices have to come down and interest rates have to come down? What do you think? What do you
Uh,
see?
So my guess is I'm going to share another screen with you, and I'm going to walk our listeners through it. Um, can you see my screen?
Getting there. There we go.
Okay. So this is the inventory that's listed for sale of existing homes. This does not include new builds. It just includes people like you that owned a home that wanted to sell it for whatever reason. For you, it was a relocation. For other people, it may be it's just their family's growing and they need to size up, or maybe they're empty nesters, they need to size down. So that's so you can see since the bottom of 2022, where we were really, really constrained for housing inventory. Like there just wasn't anyone selling anything, right? And that was for a lot of reasons, was because at that point the price inflation was so high that people were like, well, I can't really buy another house because, now this is this last part here has been higher interest rates, you know, people just not moving because of the mortgages. The mortgage rates were so high. Well, you see, we dipped down here at the beginning of 2025, and now we've kind of taken back off, and we're the highest level of existing home inventory in the past 5 years, or pretty close to it.
Is this chart saying there are 1.54 million homes for sale right now
Yes.
in the US?
Yes.
Okay. Okay. So to put context on that, the low point in 2022 was right around what, 850,
Yeah, that's probably about right.
825,
Hmm.
825,000. And it's done a little bit of kind of seesawing, but in the upward trajectory over the last 3 years. And so now we're sitting at 1.5 million homes on the market right now.
Yeah, so that's over the past 5 years. So if you look at the past 10, you can see it's had we've come down from much higher inventory levels. Okay. So while it's high, and the reason I'm calling this out a little bit is because we've only had in the past few years normalized interest rates, is what I would call them, but higher than the past 10 years mortgage rates, right?
Right.
So now this inventory is coming up and we have higher mortgage rates. Okay. What is that going to do? Well, it slows down the market. Now, what'll be interesting is I haven't looked at this yet, so I'm going to look at uh, um, new home new home inventory.
If you're watching on YouTube, you're seeing the research process in real
Yeah,
time
sorry.
because Brad is a chart nerd. Loves a good chart. I love a good chart too. I'll be honest. This stuff scratches my brain uh, in just the right way as well. But what you're looking for is new home sales.
Yeah. Um,
Because that's another really interesting point too. Being out in Arizona, there has been like a lot of the construction, there has been a lot of construction of townhomes. There's been a lot of construction of luxury apartments, and other multifamily. There has not been as much single family from what, I can see driving around and being super familiar with the area, having been born and grown up here.
Again, this is out over the past 10 years. You can see this is 4.6 months of houses are on the market, but that is like up from basically two,
Mm.
where basically everything across the country was selling like hotcakes. Again, this is existing family homes. I couldn't find the new homes really that quickly. Um, so I'll stop sharing my screen until I find it.
Yeah,
I'll
no,
continue to look.
that's fine. Yeah, I mean, that's super interesting because when you think about even a quick real estate transaction, which ours was in Ohio, everything happened really quickly once we put our house on the market, but it was still about 45 days from offer to close. And that's quick. I mean, you can do it in 30 days if like everything moves super fast, but that, 45 to 60 day close window is pretty typical. And so yeah, that 2 months, when you see 2 months on the average being the low spot, I can imagine that that was, all of the people who are like having to fight for homes and overbid and all of those things. It's like you got to get that initial initial offer just to even win a home. And that's what happened to us this time, which was great to be on the selling side of that transaction. But it's just not been the case for so many other homes that we've seen sit for a while, right? And that seeing that 4 months now makes sense.
Yeah. Yeah. I mean, it's starting to come up and the thing I like to think about is as interest rates will go down, there's been a pent-up demand for the past couple of years for people to change houses.
Hmm.
Okay. On average, people keep their mortgages around 7 years, and that's generally about the same as for houses. I mean, there are some refinancings in there, um, but generally that's about right, at least from my anecdotal evidence. And so, here we are probably 3 years into it, 3, 4 years into it, and people are like, oh, we have a 7% mortgage and we have an elevated, we have so the reason I don't think the housing prices are going to go down that much is because we have a housing shortage. We have built fewer houses than new families being created. Okay. Um, so when that happens, you go into a shortage if it's for too long. And that's kind of where we are today. We have less inventory of houses for the people that are looking. And so I think the prices are going to remain elevated, but I think the mortgage price or the mortgage rate will come down quite a bit from here, which is nice. Now, does it get down to three? I don't think so. If we get a mortgage price of three, that means our economy is in a not a good shape. But can we get down to fives, fours? I don't know. So
Yeah, that's really interesting. And actually, so I'm curious what you think about this because I mean, we had an extended time of, well, maybe we didn't have extended low interest rates. I'm thinking about the huge, bull market that we have been in, or had, really had from after the Great Recession recovery that lasted for a good 10 years, right? Like we had a very long bull market, but we also had pretty low interest rates through that time as
very
well.
low, very suppressed.
So, yeah, so is that, I mean, was that an anomaly or did those
Yes.
things go hand in hand, do you think?
No, that was so the period after 2009, 2010, all the way until about 2020, 21. That was an anomaly period where we had very, very low inflation. We had the Federal Reserve structuring the yield curve through quantitative easing and quantitative tightening. Also keeping interest rates almost at zero. Um, you had you had a number of fiscal crises that occurred during that period of time. Um, all all kind of beginning with that mortgage issue, the subprime mortgage related issue that caused the Great Recession in 2008, 2009. So, um, fortunately, today the US consumer is in far better financial condition than they were in 2006 and 7.
Mhm.
Uh, People forget that back then everybody had, not only did they have their mortgage, they had their HELOC. And their HELOC, they were fully taking it out and buying other houses and flipping houses. And everybody you knew was trying to flip houses, and they were involved in some way in real estate and construction or development. And everybody was making tons of money until it stopped, right? And then today, we have excess savings. So the US consumer has deleveraged significantly from that time period, which makes the US consumer much more stable as a source of spending, which again, when that occurred in 2008, 2009, it really was impactful because not only did you have your largest asset on your balance sheet go down in value to being less than the value of your mortgage, okay? So you had that period going on, but you also had that also um, forced consumers to curtail their spending so they could pay these debt payments, right? Or they walked away from their houses that they were underwater on. We don't have either one of those that will occur. In fact, we had kind of a surplus back then. Now we're in a deficit from an inventory demand and supply framework. We're in a completely opposite situation today as we were back then. You look at the consumer balance sheet, completely opposite. We were levered back then for our spending. Today, not nearly. We've deleveraged significantly during that period of time. So we're in a very different spot than we were back then, which is why I think, yeah, I mean, we could go through a period where housing prices kind of stay stable. They go up and down a little bit depending on where you live, but until home builders really start to build excessive amounts of inventory, probably not going to be that big of a deal. Now, locally, I'll just tell my experience in Utah and in Arizona. Um, Certain parts of those markets will get saturated by overbuilding. They'll build too much for the populace. So different pockets will struggle more. But for the most part, I think as long as you're in an area that is growing economically speaking, you should not see very much downside on your housings.
That is that is really yeah, it's interesting, and it's been an interesting phenomenon to see and to kind of see where the shifts are happening. Um, just anecdotally, I know a lot of people personally who have moved to Austin in the last couple of years, and that housing market has really climbed, just like anywhere else where you have a large influx of people moving, either from, I've had friends that have moved from California, from Arizona, from the East Coast. Like, it's just a hub right now of where a lot of people are going. Yeah, and the housing market's really reflecting that. So, I
Absolutely.
we talked about this a little bit at a meeting the other day, talking about private credit, and that could be an interesting topic to pick up as well. Not today, but the way that home builders are having to utilize private credit, I think is a big aspect of that we could go into. We've talked about it before, but
Yeah,
could
we've touched on it before. I think it'll dovetail nicely into what I think the Trump administration is now pivoting to, which is you notice tariffs have gone into the background. We don't hear hardly anything about tariffs any longer, particularly any negotiations. What we're now hearing is about the tax deal that's trying to go through, and then he's going to pivot to deregulation. Now, the reason I want to talk about deregulation in a future time is because I think it really is going to dovetail nicely into banks and bank
Hmm.
lending. And one of the reasons, for example, real estate developers and home builders have been constrained about how much inventory they can buy and how much they can develop is because they've been constrained on how they can raise funds. So when you're constrained on raising funds, typically the cost of those funds is a little higher. And if the deregulation comes to banks where the Trump administration says, "Hey, we can take a little bit of risk on some bank balance sheets, not much, but a little more than, basically no, very little risk." That could be all of a sudden home builders now have another avenue where they can go to the bank and try to get some development loans, which used to be the place that they all went
Right.
to get funding. So I think it'll be an interesting dynamic in the next 12 to 18, 24 months. Uh, is banks, particularly regional banks and home builders, I think could be a pretty bright spot going forward.
Okay. Last thing that I want to talk about today, because we talked about this last week, and basically you called it that there was a potential that we might be the ones to drop bunker busting bombs on Iran. And sure enough, the very next day, that's what happened last Saturday. Um, and it's very, again, like I'm very interested with all of this. Like the markets are up, everything seems fine. What's going on with that? Is that just another piece of the bad news is good news, or what are you digesting from what happened
Um,
over the weekend?
More of it, yeah, it's a little bad news, good news, because bad news, hey, we had to go in and bomb Iran. Good news is their retaliation was symbolic in nature. They called us and said, hey, we're going to shoot missiles at these bases at this time. And so we could evacuate those bases with everybody except for the anti-aircraft gunners who then shot down the missiles that were coming in because they knew they were coming in. Um, so it was symbolic in nature. Um, Again, I don't know. Our intelligence has said that there's a probability that um, it's been destroyed or has had severe damage. Israel's intelligence, from what I've read, has said it's now buried. It's basically um, it's still there, but it's buried under so much concrete, granite, all of that stuff that it would be very, very difficult to get any of that stuff out and have it usable. So they think it's a total loss for the regime for the Islamic regime of Iran. Um, and so that's because the way it went about and because Iran didn't really or Iran didn't really retaliate that much and they haven't closed the Strait of Hormuz.
Hmm.
um, it's kind of a non-event because it's reduced the uncertainty in the world, if that makes sense. It they're no Iran and Israel are no longer shooting at each other right now. So they're in a truce, although it's going to be a shaky truce. If the Ayatollah comes out of his wherever he is located at some point in time, my guess is Israel takes him out as part of their campaign. But we'll see if that ever happens or what. But they've effectively pushed back the Iranian nuclear ambitions by at least a decade or two. which is expensive. I mean, developing all those projects and those it is a very, very, very expensive proposition. And when, as a regime, you're kind of on the ropes. It's one of the reasons you've seen the Crown Prince the Crown Prince of Iran, come out and say, "Hey, it's now our time to take Iran back." Um, the Islamic regime is a no longer a legitimate government. Um, but I think the U.S. and Israel and Saudi Arabia does not want to do regime change.
Hmm.
They don't want us to force regime change. We've
Right.
seen how that happens in Afghanistan and Iraq. It didn't work out so well. It makes it more of a hotbed mess than anything else. Um, but it's different if the Iranian people rise up and take out the regime. Okay.
Right.
And I think that's what they're waiting for, is to see, okay, the populace in Iran does want a new government. Okay, well, we have someone who's already said, they're the crown prince. He can come in and run, for a year until they can have democratic elections. Once they have elections, then we see how it all transforms into a democracy. We'll see. Again, those are, far far out conditions. Those are not by any stretch of the imagination um, forecasts that we're confident in. But it reduces the uncertainty across financial markets. The fact that they didn't close the Strait of Hormuz is a very, very big sigh of relief for China,
Mm.
because China buys almost all Iranian oil.
Oh, wow.
Yeah. So, and they're between the US, India, and China, we are by far the very, very largest um, consumers of oil. And
Right.
so, if they closed the Strait of Hormuz, China would have a problem with that.
So what I'm hearing from that is, one, we know this for sure. Uncertainty breeds, volatility in the financial markets. So literally anything, as we know, that brings down that uncertainty also allows the markets to breathe. Um, and what we may have been bracing for, like some, again, we've talked about it before, black swan events, we may have been bracing for something like that to see what happens. We didn't get that over the
Correct.
weekend. It didn't turn into what could have capitulated into what we call a black swan event for the
So far.
financial markets so far.
Mhm.
So geopolitically, things are still crazy out there, as
Yeah,
an
I mean,
understatement, but
yeah, I think that's true. I think what's interesting to me is the dynamic and the narrative shift in from the Trump administration regarding Russia. And people haven't noticed this as much. But President Trump specifically has started talking about, has gone from kind of anti-Ukraine to more positive on Ukraine. I'm not saying he's a full-on proponent of the Ukrainian cause, but I would say that he is much more empathetic to their cause than he was a couple months ago. And it all has to do with the fact that Putin, who he thought he knew and was a friend with, keeps dragging him along, and at the same time committing far more war crimes than he was prior to President Trump being elected. So it makes President Trump, I'm sure he's feeling it. He feels like Putin's making a fool of himself, making a fool of President Trump, or at least attempting to, in front of the world, because he says, "Hey, you're trying to talk me off the ledge here, and yet I don't care. I'm going to put 350 drones into Kiev overnight with 20 missiles." I mean, that doesn't show someone who is respecting President Trump's efforts to have a peaceful resolution to that conflict. So, by that stretch, now President Trump has to reassess President Zelensky and his desire to have Russia leave his country and
Hmm.
to just to have their territorial borders be respected and to be accorded every right accorded to a sovereign nation, which again, Russia has violated almost every bit of international law with this invasion back in 2014 and then again in 2022.
Yeah. Well, we will continue to watch and discuss and um yeah, just follow what's happening and again digesting it, seeing how it turns out. But for now, again, markets are rallying on all of the not so good news. So yeah, just watch that while you're hearing these different things and seeing your portfolio increase for the moment. Again, the stock market is a future predicting measure. It's forecasting forward. So anything that seems like it's going to cause earnings in the future is going to make the stock market rise. It's going to say we believe this is the right pricing for 6 to 9 months from now. Is that right? I don't know. We'll see when we get there. Sound good?
Sounds perfect. Sounds perfect.
All right. Well, if you have any questions, um, always feel free to send them along. Um, oh no, I did forget. I did forget something. My good friend Bob asked about Social Security. So,
Oh,
Bob,
okay.
I'm sorry. We forgot to talk about that. We do have a couple minutes. Do you want to talk about?
Let's go for it. What's the
Okay.
question?
Well, Bob was seeing again, like we hear every once in a while, right, that the Social Security and Medicare trust funds are going to run out. And now the most recent one said 2035. So being in the demographic, I think around almost 62, he's concerned. He's saying, what are we gonna do if Social Security runs out? And it's a good question. There are a lot of things that we can think about, forecast, predict, but overall, that's still, especially for someone who is about to take Social Security or eligible for Social Security within the next couple of years. My feeling has been for a long time that the government can't pull the rug out from under people who are currently on benefit or very, very soon to start their benefits. Because I mean, that's like the government is falling apart at that point if they start taking away Social Security, which is something people have banked on literally for the last, what, close to 80 years
Yeah, somewhere on
at
there.
this point. So what do you have to say to that?
So 2024 trustee report said the Social Security Trust Fund will run out of funds by 2033.
So that was last year. And now they're saying 2035.
Yeah. So, and that's typical, right? Because, um, so the disability insurance fund will not run out of money until 2051. So
Oh,
that's
interesting.
better. Okay. So that's just disability. So what happens if in 2033 the worst case scenario happens? Okay. It won't go bankrupt. It would have to cut. The estimate right now is they'd have to cut 23% of the benefits to each recipient right then. Okay. So if you're getting $2,000 or $1,000 a month, they're going to cut it by $230 per $1,000. Okay. So it's something that you can plan for, and I would suggest planning for it,
Mm.
just in case, right? We want to make sure that you have other sources of income to make up for that, just in case that happens. Um, but also, there's a bunch of solutions that are being debated right now. One is eliminating the payroll tax cap, which right
Right.
now you every worker up to $168,000 pays a certain percent in for to support Social Security. Okay, well, they could raise that to 250,000 or 400,000 or or make it there's no cap. You pay it on every dollar you earn. So that's one way to shore up the finances of the Social Security Trust Fund. Um, they could also increase the retirement age, which is kind of the scheme, the methodology they've gone down in the past, right? It used to be you'd get Social Security at 65. Well, now it's, 73, 75, 77, depending on what age you're born.
60,
Um,
not 73, 60,
73,
no, 65, 67 for most people.
60. Okay, hold on. Let's back up. Did I say 77 or
You
67?
said 77.
Oh, I'm
Yeah.
sorry. I meant 67.
Okay.
Jeez. So I added 12 years on. Come on. That's okay.
That's it's
You
just
know,
a minor error.
yeah, minor error. Sorry. So, but they could change that retirement age, right? They could
Right.
stage it in again and saying, okay, well, 67, but if you wait till 72, 73, we could pay you more. They could do that kind of scheme again. Or they could say, if you make over X amount of dollars in retirement off your investments, you don't get Social Security at all. Zero.
Right. We call that means testing.
Yep. Yep. So, for example, if you're making over 200 grand a year in interest and dividends and capital gains or pensions and IRA distributions, then you probably don't need Social Security. Whereas someone who, has a small teacher's pension or and they don't have any other funds or those people might need it more than the others. So that's another way they could do it.
And
Um,
I want to say that actually already exists for age
yeah.
62 till full retirement age. So when
Hmm.
people are like, well, that's not fair. They don't like, well, it already happens. You're
Yeah.
technically eligible to take Social Security at age 62, but if you make more than I'd have to look it up. I think it's around $19,000 right now. If you make
Yeah.
more than $19,000 a year, you don't get any Social Security benefit. It gets
Right.
clawed.
And that's always a shocker for the first year when people figure that out.
Right, exactly. It's like, no, no, you made too much money, so you can't take Social Security. You have to wait. Um, and then it gets pushed back to later. So we already do a form of means testing. So if they just extend that and say, well, at 67, if you, like you said, if you have income of more than $90,000 or 150 or 200, whatever it is at that point, if you have income of more than that, then we claw back all your benefits. And then maybe in the future, if you're 80 and now you don't make that much, then we'll start giving you benefits.
Yeah.
Right. So
And I
it's,
think I think they're going to do a combination of all of these things, by the way. I think that they're going to um, do all of these things. I think that they're going to do means testing. I think that they're going to have to extend the life of extend the age of full retirement, and they're going to have to uncap the payroll tax. None of these are going to be very popular with anyone. So
no,
just no one, if any of our listeners or viewers, no one's going to think this is a these are great solutions. They're not. It's just we have to do something. Otherwise, they do run out of money. And what happens is then the benefits get cut immediately.
right.
Um, they could also cut future generations benefits. So they could come in and say, okay, well, as of if you were born after, before the or after this date, your Social Security will be half of it, but you're still putting in the same amount. Just to shore it up. I don't know what the solution will be. That's for the legislators to decide and the president. So, but they will do something to make sure it extends its life. It is a very important component for many households, but for a lot of households, it's not that necessary either. So we'll see.
Hmm. Yep. Super interesting. Well, thank you for shoring that up with me. So make sure keep my promises.
That's right. That's
So
right.
if there are any other questions, always feel free to send them. We would love to talk about them on the podcast. If you are finding this helpful, and it's helping you feel calm within the storm that is the financial markets for any reason, we would love for you to like, share, subscribe on whatever platform you enjoy. That really helps the algorithm push it out to more people. And the more you share, and then if you tell me about it, you'll just make my day. So it really does feel good. It fills my heart to know that what we're doing and what we're saying and what we're sharing is helpful to you as a listener. So thank you all so much. And thank you, Brad, for being here.
Thanks.
That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, HANNAH, at expansiveceo.com and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough, you are enough, and your birthright in this lifetime is to be expansive.